Swayam Prabha. Digital India. Educated India.
Hello everyone, welcome to my lecture. So today we are going to wrap it up our discussion on the insurance and then different kind of informations that actually lead to adverse selections and also moral hazard. So in context of say insurance, we had taken couple of examples. Like in terms of insurance, we spoke about the risk. In context of risk, we spoke about two primary behaviors. One is risk aversion, the other one is risk loving, and then also there is three categories like risk neutral, where people will not tend to take any risk. In the risk aversion is basically that is the what people's general behavior, like we tend to take less risk because of that rationality's point of view, like rationality as one of the principles of economics. So in this particular context, we'll be talking more on the role of information in economics. And in this context, two celebrated concepts that are used. One is adverse selection and the moral hazard, and then there are a couple of markers were taken into account. So while defining this particular concept, there is a lot of changes that and development had taken place in the context of market debates in microeconomics theoretical framework, and there asymmetric information was taken into account, and then scholars like George Akerlof, Michael Spence, and also Joseph Stiglitz, they have actually developed they have used asymmetric information, and then they developed or tried to give us alternative thinking about the imperfect market conditions. So we'll discuss and we'll try to wrap up our discussions on risk, return, and with the help of asymmetric informations in this particular lecture. So to begin with, I would also like to introduce broad branch of economics that is based on the information and a lot of uncertainty. So in uncertainty and choice, this information has taken a lot of important role, and therefore information economics is has come out as one of the subdisciplines within within economics. So what does that mean? So information economics, it refers or focuses on the information in the market and then market dynamics. So market is not static. It gets fluctuated with a lot of uncertainties, and that's how the choices are made. And then market decisions, also require a lot of informations and perfect information, and that is what we are trying to discuss. And we also know as a student of economics that in perfect competition market, perfect knowledge about the product and perfect information, these are the prerequisite conditions, and as well as the strategies to mitigate inefficiencies. So when we see that there is no perfect knowledge, perfect information, and then that is the point on which we talk about inefficiency. So in terms of equilibrium point of demand and supply, or for say perfect competitive markets conditions, we see that inefficiency comes, and then one of the sources of inefficiency is basically not a proper information, and caused by informational frictions through design of institutions or institutional measures. So this is what collectively we can call it, like part of the information economics. So now let's move forward with asymmetric information. And what does asymmetric information? So before getting into asymmetric information, let us talk about what is perfect competitions. So in perfect competition, perfect knowledge about the product in the market is required, and that actually, if that doesn't, then of course there is a violations. And as we see that even in case of externalities, even for the demand and supply, even if they are at the efficient point where there is no excess supply and then there is no shortages, but still it could be private market efficiency, but then certainly it is not a efficient outcome from the social welfare's point of view, because one of the communities will be getting adverse effect. So that is a violation that we are talking here, and that violation actually becomes or makes or generates asymmetric information. So now let's move further. What is asymmetric information? So asymmetric information is the situations that we are defining where one of the two parties, like if buyer and sellers, we consider as the two parties who do not have access to the relevant information. So if we hide some information, you can imagine about the market for the used car or market for the second hand commodities, like say in India, OLX is a website through which we can actually buy or sell the second hand commodities. In that there is a question about the asymmetric information, or question of whether seller will give the perfect information about the product. So this is where the situation that we are defining, that one of the parties does not have access to relevant information. So even sometimes a seller will have all the information, but then buyer will not have, and sometimes even seller gives the exact all the information, then buyer will not believe that seller is giving entire information or perfect information, or buyer always will doubt whether seller has given or shared all the information that is required to make his decision. So these are the dynamic informations and then decisions that we are talking about when we talk about asymmetric information. So now examples could be many. So one of the examples that I had given is a second hand car. Then insurance companies, another point that we can talk about asymmetric informations, and also the banking, like lending the loan or borrowing the loan, and then bailout, for instance, in case of extreme cases. So these are the cases that we can actually consider about the market outcome that are arising from asymmetric information share between the parties. So this is what we are trying to understand. But then of course asymmetric information is a very big concept, and then we try to understand what are the decision making processes. Like selection is a decision making outcome, and adverse selection, if that is coming, so perfect selection is coming from perfect information. If I get adverse selection, it is actually coming from the asymmetric information. So we'll discuss about this, especially from the characteristics and features of information sharing point of view. So now let's talk about adverse selection. So dealing with the imperfect information. So and that's what adverse selection. So when we are dealing with perfect information, there is no question, or there is a very limited ideas of, or there is a very less expected value or less probability that we'll get the adverse selection, right? So in this particular context, there are concept called market for layman that was introduced by George Akerlof in his very famous and seminal work published in 1970s. So we'll discuss that a bit, especially while defining the characteristics and features of the market layman's. So information, when we are talking about imperfect information, so here we are talking about information that buyers and sellers they deal with. So a buyer, just take an example of the used car. Just imagine a buyer of a used car has very little knowledge about the car, and then potential problems that may arise. So on the other hand, the seller knows a lot of information. I'm not saying here that perfect information, but then a lot of information about the car. So sellers always will be willing to sell defective cars before the other car which are less defective, and therefore the concept that bad product drives the good product, that particular concept came. So now, while defining adverse selection, it arises when an informed individual's trading decision or exchange decision depends on privately held information in a way that adversely affects other uninformed market participations or participants. So here, in the point that we'd like to highlight, again we want to bring the Pareto efficiencies point. Like there, when we were talking about efficient outcome or optimal choice, there we spoke about Pareto principles and Pareto efficiency. So if you recollect those concepts, again it is coming here because when we deal with information, actually we are talking about economic efficiency or economic efficient outcome. So as a result, when we are not sure as a buyer and seller, then of course with the imperfect information or with asymmetric information, we can't deal or we can't get the first best choice or first best trade cannot be achieved through adverse selection or through asymmetric information. So now market failure, that of course will lead to market failure, and then I will not discuss much more in detail how market failure comes, but then market failure I'm just here trying to connect with asymmetric information, which is due to asymmetry of the information. Sellers cannot sell high quality products at high prices because information was not perfectly given, even though buyers would be willing to pay more if they could verify cars quality. So this is what the point that George Akerlof also highlighted in his text. So when we are talking about adverse selection in details, so I'm referring this market for layman's, the quality of uncertainty and the market mechanisms. This article seminal work by George Akerlof, published in the Quarterly Journal of Economics in 1970s in their August issue. And then there the problem that it was discussed is the core problem that George Akerlof dealt was with the quality uncertainty of the products and asymmetry of the information. So here, even with the asymmetric information, there could be good quality and also bad quality, and then but then also from the buyer's point of view, there is uncertainty. So the problem setup, how problem that set up. So market for used car, again you take the example, that's I'm also taking this as an example because we see these applications both in the developed countries and developing nations. So we can also see in credit market, for instance, in the rural India, we also see similar kind of characteristics. In fact, George Akerlof in his article about this market for layman had taken the example of credit market in rural North Indian rural market. So take the example of used car, and two types of cars here, even within asymmetric information framework. Even in the second hand car market, there will be some car will be really high quality, and some car are actually of low quality. So even in the used car market or in the second hand product market, some product are really their quality is much higher as compared to the other product. So there is no concept that used car market or second hand product market there will be all the quality quality of the products will be low. So it is not that the case. That is where the search will be there, like that's how the expected value that we need to calculate, because there will be some higher probability that I get is the better quality product from the second hand, and there also will be the chance that quality is so bad, and therefore there will be certain probability. So here certainly there is a probability because there is a risk associated with that, and therefore expected utility also will change. So these are the discussion that we already discussed in context of risk. So expected utility, expected value, because there is a probability of the events that are associated with this. When we are talking about high quality and low quality, in fact we are not sure how much high quality and how much low quality, and therefore there is a probability that is associated with that. So of course, from the seller's point of view, sellers know exact quality of the cars that they are selling. So which parts are actually bad, which parts are relatively much better. So these are the perfect information about the quality of the car. We can actually expect that sellers will have it. But on the other hand, buyers absolutely do not have any idea, do not know exact quality of the cars they buy. Certain, of course, here one of the debates, like with the pictures that we see first, before getting into the physical verifications of the product from the buyer side. So we see from the pictures and then we try to verify. So when we actually verify the car, then of course some information will be much more clear, and then as a buyer we get some kind of information from the from seeing the car physically, or for that matter for any product. So but then of course whatever it is, actually buyers will not have absolute all the informations about the quality of the car. So there is of course some differences will be there. So now let's take an example. Say assume like high quality cars are worth of say 5 lakhs rupees and low quality car are worth of 2 lakhs. So suppose that people know that in the population of the used car, and then here we are taking some benefit of doubt, and then we are giving equal probability. So probability for the high is half, which is like 0.5. So it is like probability of the used car with the high quality, and then probability with car with the low quality, again I am giving like half, which is like 0.5. So this is where we can actually kind of understand the population there, and then their probability, and then how much they are willing to pay. So what is the expected value? So say if car is, we are referring here second hand car, used car, as say used car is we are referring as X, and if you recollect, expected value is expected value of X that we are referring here. So here what is the value that we are getting it, like 0.5 multiplied by 5 lakhs plus 0.5 multiplied by 2 lakhs, which is coming 3.5 lakhs rupees. So expected value. So if I consider entire probability and then value associated with that, and then if we the kind of overall aggregate, like expected value from this used car is like 3.5 lakhs. But this includes very high quality used car and also very low quality used car. So people are willing to pay. So this is what we are saying, that people are willing to pay 3.5 lakhs for an automobile like the car, and who is willing to sell an automobile at 3.5. So certainly the high quality product, like which is the worth of 5 lakhs, they will not actually come forward for 3.5 lakhs. So people who has the value which is less than expected value, so actual value we can see this way. So actual value of the car, if it is less than expected value or equals to expected value of X, and here X is used car, then certainly they will come forward. So who will come forward? Like low quality car owner will come forward, because for them this is certainly is a benefit, and therefore low quality car will come, because that's worth of rupees 2 lakhs. So only low quality car owners enter in the market, and eventually low quality car will drive out the high quality car. This is what we are actually saying, that in the, again, anecdotally speaking, there is a very famous argument, bad money drives a good money. So in this particular context, we can also see, low quality car will enter in the market more, because defective car, car owners of the defective cars will come forward, will enter, and will try to get rid of the low quality car in the second hand market. So this is what is very, very interesting way to understand expected utility from the high quality car, second hand car, and also expected utility that one owner will be deriving from the low quality of cars. So now moving forward, what is the solution? So of course, this the car, me as a buyer, is my expected value that I am expecting and I'm willing to pay is like 3.5 lakhs for an auto, or car, but then I get the extremely low product, low quality product, and then this is definitely is a lemon for me. And that's how in the market, especially in developing countries and also in the second hand markets, there are so many segmented of the markets which has markets for lemons. So lemons are is adverse selection that I get it as an outcome. So what do we do? So in that particular case, because there is no liability, it's informed kind of decisions by the buyers, and this is coming, I'm getting lemon from this particular market because seller did not share the perfect information in this particular context. Although my expected value is 3.5, but then I got the car which is just the cost of that particular car is just 2 lakhs, which is of very low quality. So now what is the solutions in this particular case? Money back guarantee, a lot of guarantees are coming, market signaling, first there will be warranty, some sort of warranty is given. So some companies, they are actually giving that kind of promises, and then expert check, even if I go with the go to the market in the second hand market, then I'm free as a buyer, I'm free to bring my own expert and try to check, and then I should be properly informed before buying the product. And then also the licensing practices. So these are the checkpoints when we deal with asymmetric information in the market. Broad applications of the lemon principles. So these are the principles that we are talking about. One is insurance market and cost of dishonesty, and then of course the employment. And then there are a couple of many markets that we see where lemons principle can be used. So now moving to the next point, moral hazard. So that is also a very, very important concept here, because it arises from the adverse selection, and adverse selection arises from the asymmetric information. So moral hazard is also coming from asymmetric information, and this is the conditions that we see. Moral hazard is also kind of behavioral kind of behaviors or the attitude of the buyers, or could be sellers as well. But then it defines the situations where the private information is about the choice of an action and efforts. So this private information, there is the trick, is this private information could be perfect information and also could be asymmetric information. So here there are 2 points. It's principles and agents that that we understand in economics. The principal needs the agent to carry out a task because he or she is not able to lack of expertise, or not willing to carry out, lack of time. So the moment, just imagine if I'm a startup or as a small business man, and then I want to do certain business, but then and then as it grows, then as a single person it is difficult to manage everything. Then I hire some management to manage the entire my business activities, and then there will always be information gap between me as a principal and the agent, like manager as a agent, and that's how it pass it on to the consumers or the buyers. So manager cannot perfectly control the salesperson's effort or provide the perfect information. So there is a lag. So in this particular information economics, if we plot it, so principals and agents, they play very important role. Some of the contract relationships that I would like to discuss here is like employment contract between managers and employees. So we are not very sure as employees, sometimes at the time of taking the job, we don't know about all the information about that particular job, but then once we get into that contract, and after say 1 month or 2 months or 3 months or after 1 year, we get to know certain things which were not declared in the contract, and in the job contract it is not necessary or it is not practically possible to provide all the information about the job, and therefore this kind of contract can be challenged, and this kind of misinformation, adverse selections and moral hazard arises from this kind of unintended contractual contractual relationship, right? So manufacturing firms and subcontractors, then we also see that a lot of information gaps between firms, principal firms or subcontractors. Financial contracts between lenders and borrowers, and mechanics and the car owner. There are also a lot of kind of information gaps that arises between mechanics and car owner. Also some of the information gaps there between lawyers and clients, and also insurance contracts. So the banking crisis can be taken as one of the examples that we have seen in various time point in any of the economics, like across the world, like bailout of the banking system, say in the great financial crisis in 2007, and we have seen that during banking crisis we have seen this kind of things to happen. So for banks who takes the risk, believing that government would bail them out if they fail to kind of to fail to cover. If things do well, then it is a gain for the bank. If it goes bad, then bail on the government and takes taxpayers' money. So this is what the point, that it's a moral hazard, that bank is taking risk because of bank knows that government is there. So there is a moral hazard point. Same moral hazard issues also it is like with the big companies that contract with the government. So even during the bankruptcy, big companies, they also always think that like government is there, and then if anything happens wrong, then government will be there. So it is like we are taking as a risk because we know we are protected by somebody, and here somebody is of course the government. We can take a couple of examples here, like say insurance, and then say if my car is insured, then some of the times or most of the times we don't care about if I hit the car or if my car is hit. Then at that, like we know that if something happens wrong, then my entire car will be taken care of by the insurance company because I have taken 100% insurance. So in that case, so I'm little risk loving person right now here, because I know that my car is fully protected. Similarly, health insurance, if I have taken complete health insurance package for my health, so sometimes even if I'm I'm not allowed to have more sweets, but then I kind of take some chance to have some sweets, because I know if something goes wrong, my health insurance will cover some of the medical bills. So this is the cases, and also these are the moral hazard examples of the moral hazard. Even say house protections, like if I take the loan, I also take the loan like some of the insurance that will kind of protect my any of the fire, if fire happens, or any sort of if I fail to pay entire EMIs, if I have taken home loan, then my insurance company will take care. So that particular insurance that I want to take it, because I want to safeguard my or I want to protect my home loan or housing loan. So these are the cases where people take risk, because people knows that some protection is there through the insurance. So in the insurance or in the banking sector, we see quite often this moral hazard behavior of the buyers or the consumer side. So effects of moral hazard: transaction may be less likely in the first place. If the government thinks companies will act recklessly, then may choose not to contract with them in the beginning. So that is the effects. And if you think that car mechanics will always suggest you to change your tires, never listen to them until your car your tire becomes completely flat. So that is what kind of effects that of the moral hazard. Like, we always we think, but then there will be some checks and balance where there will be adverse effect of moral hazard as well. So dealing with moral hazard through institutions, there are a couple of measures. So how to prevent workers, sellers and buyers? So hire employees to monitor other employees, and in this context, some companies or some people, they go absolutely extreme. Like for instance, CCTV installations in the at the workplace. This is also one of the ways in which you check the employees. Users ratings that play quite favorable, like say trip advisors, and also policy bazaars in case of say India. So policy bazaars will give you some sort of comparisons, whether you go for this particular insurance or that particular insurance. So that will help you to give you help you to take perfect information about the product. Enhance information and discipline service providers. So it's like splitting the diagnosis from the actual treatment. Like, that's how in the public hospitals, if you have noticed, you will see that some doctors will there is no designated doctors who will actually guide you throughout from your surgery to the regular checkup. So surgery will be taken care of by some set of doctors, and then your regular checkup will be done by some other set of doctors. So it is actually just to control this kind of issues with the moral hazard. And there we always we hear that especially for the health point of view, that you before going into major surgery, take the second opinion. So this second opinion, just to check and balance about the insurance. So I will stop here. I hope this actually clarifies with these two concepts, especially moral hazard and adverse selection, that arising from asymmetric informations and asymmetric information. And in our entire discussion on the certainty and choice, and these are the two references that I have used, and I'll highly recommend that you please go ahead and read George Akerlof's this seminal work, this particular article, The Markets for Laymen, Quality, Uncertainty and the Market Mechanisms. And it is very well and highly cited article, and also some of the expected utility and risk point of view, when you can also see Jonathan Gruber's this particular public finance and public policy articles. Their adverse selections are defined from expected utility and expected values point of view, which already we have discussed in our last couple of lectures. So I stop here, and thank you very much for your attentions, and I'll see you in my next lecture.